Hello and welcome back to our series on what is the market. We have made it to the who section of our topic here, the who's of the market. Who are the market players? And we're going to go with companies this time. We've been talking about speculators, we've talked about hedgers, we've talked about investors, and now it is time to talk about the companies that actually exist in the market and the companies that are trying to exist in the market. So we're going to kick it off with private versus public here. A private company is one that is not accessible to the public. Wouldn't you know it? A private company might want to go public. You hear about that. You hear about an IPO. And what IPO is short for is initial public offering. So if I'm a company, let's say I own, I don't know, cheap couches and I want to go public. I need more money so that I can make more cheap couches so that I can finally buy a really nice expensive couch. So I need more money because I need to make more couches and scale up this business. So what do? I do an IPO and I offer the company, or sorry, offer the public rather, shares to my cheap couch company. So I go out there and say, hey, I will sell you a share of my cheap couch company for $5 a share, and we are going to issue 1,000,000 shares. Okay, you can buy a share for $5, and there's going to be 1,000,000 of them. Okay, that means my company is worth $5 million as long as people are willing to pay $5 a share, and there's 1,000,000 shares out there. That means my company's worth $5 million. I can finally buy a nice couch. All right. Um, Existing companies, public companies that are already on the exchange, can issue more shares if they want. If they need to raise more capital, they can issue more shares. Okay, so that's an IPO. And then if the company is issuing more shares, they call it a secondary offering if the company's already public to begin with. Okay. Quick note on shares. There are multiple classes of shares. The ones we normally deal with and talk about are called common shares. Okay, and there are lots and lots and lots and lots of common shares. If you look at a company like Apple, they have 15 billion common shares outstanding. 15 billion. Their shares are out there in the world, tradable. Funds can buy them, people can buy them. 15 billion of them. Each one is currently worth $241 and some change. So if we do the math there, Apple's worth about $3.6 trillion at the moment. So if we took all those shares and multiplied it times the current share price, you'd get about $4 trillion. Those are all common shares. Okay, the next thing we have are shares. They have no voting rights. You can't bring a preferred share to the table and vote on anything. But they do get better dividends and they have more priority if the company were to liquidate. The preferred shareholders to get paid first. Okay, then you have Class A and Class B shares, a little bit different. They have more voting rights typically and sort of a different dividend structure. But Class A shares usually much higher on the voting scale, but lower dividend payouts. And they're often held by company founders or executives to kind of maintain control. Okay. And again, another thing companies could do, they can go and issue more shares. That's a secondary offering, or they can reissue shares that they have bought back. So let's say again, going back to my couch company here, I issued 1,000,000 shares at $5 a share. Let's say I'm doing pretty well. I can buy back half of my shares, which means now there are only 500,000 shares out there. Okay, if the shares have appreciated, the company could still be worth $10 million or $5 million or $100 million. The number of shares is only one half of that equation. So I could buy those shares back, giving myself more control of the company and having more shares available to issue later if I need to. And that's called reissuing shares. Okay, so I can issue shares initially, company can buy them back later on, and then I can reissue those same shares if I need to again later. I can also issue bonds. A bond is just debt. If I issue bonds, I say, hey, give me $1,000,000, I'll pay you 5% per year for the next 30 years and then give you your $1,000,000 back. Okay, that's what a bond is. It's just basic debt with an interest payment. You can get kind of funky with bond specifics, but in essence, it's just a debt. Okay, and that's another way that a company can raise money in the markets. They can do an IPO, which is a company that is not public yet. They can do a secondary offering if they are already a public company. They can reissue shares that they have previously bought out of the marketplace. They can reissue them, or they can issue debt via bonds. Okay, the other thing that's kind of interesting here is that the market price of a company can drive the company's decisions, and the company's decisions can drive the price of the stock. Okay, if a really bad decision happens in a company, it can tank the stock price. At which point, more decisions have to be made to sort of, make the stock price grow again. Or it can go the other way. If the stock happens to tank on its own, the company is going to have to turn around and make decisions to try to prop up the stock price or do something to make that stock price go up again. So it can go either way. You have a dog chasing the tail, or a chicken and egg kind of situation. Both of those things can affect each other. Company actions can affect the stock price, and the stock price itself can affect company actions. Okay, and that is it for our Who's of the Market series. We got no more people, no more players in the market. And then the next time we're going to enter into the last segment. It's going to be the wheres of the market. We're going to talk about the wheres of the market, where things go on. All right, so thanks for tuning in. This is Matt Williamson for Sigmanomics. Take care. All right, that's going to do it for this video. Our next video is going to be on hedgers and their role in the marketplace. So thanks for tuning in, and we'll see you in the next video. Take care.